Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Markets are about probabilities. The only certainty in the markets is uncertainty. In fact, it's one of my favorite quotes. I use it quite often in a lot of articles. Words such as impossible and guarantee should probably be replaced by highly unlikely and most likely. Investors must decide if the risk is worth the reward. Understanding financial risk can help investors decide which assets are right for them. So the more you learn about options, the better off you are, so that you can look at your portfolio and try to hedge it the best way for you. Many investors may want to consider diversification, finding assets that have relative value but do not move alike. Or, there isn't any guarantee. At some point, even though oil stocks and airline stocks should not move alike, I'm sure in the past, historically, they probably have. But the idea of trading foreign currency options, you may see, and when we've seen this recently, that a lot of the pairs are actually moving the opposite way of the equity market. Diversification, the goal may be to find assets that have relative value but do not move alike in the markets. The term is correlation or lack of correlation. So correlation just means, are they moving lock sync? Are they moving in the same direction? Markets, let's just say that the stock market's moving up, or all the assets moving in the same direction. That would mean that they're correlated. But again, markets don't always move up, so a lot of times you're going to want to find assets that might move down when the market's moving up, because when the market's moving down, those assets might be moving up. So low correlated assets will hopefully help smooth out investment results. And again, I say hopefully because, you can have all the most advanced models, but there isn't any certainty for sure that this will occur. But at least in theory, if you put a small portion into something else that's not correlated, it may make sense. So let me go through some options and asset classes: equity, index, and ETF options, options related to the bond market. So there are a lot of ways. You could trade good old IBM, as I call it, Google, Research in Motion. These are just names out there. Of course, there are thousands of equities, index, and ETFs that are available for trading. And I just named a few, but again, there's nothing wrong with any of the names that you're trading. Options related to the bond market, one example would be TLT. Options that are based on foreign currencies. And as I said, YUK would be the dollar-yen, EUI would be the dollar-euro, BPX would be the dollar-British pound, the CDD would be the U.S. dollar against the Canadian dollar. AUX, and that's recently been the most volatile. Historically, we'll see how that all plays out. But at least in the last couple of months, we've seen the Australian dollar take quite a beating against the U.S. dollar. And the symbol there, if you have an opinion there, is AUX. And lastly, U.S. dollar against the Swiss franc, SFC. We have options related to the commodities market. One would be GLD. Options related to the real estate market, IYR. So there are many other ones also. There isn't any one best option strategy. It's important to understand that. So your trading results are going to be based on your ability to take risk, which strategy select, what subsequently occurs in the marketplace after you implement your trade. So are you right or wrong? What volatility did you buy? And was it really much more volatile or less volatile after you put the trade on? What strategy did you select? How did you manage your trade? So these are a couple ways to look at the markets. Portfolio results based on many factors. Most importantly, your choice of investments. How did you handle your winning positions? How did you handle your losers? Managing your losing and winning positions are equally important. Sometimes, many of us start to look at it one way or another, but they're both important. If you think of it as a big seesaw where you're just basically looking, and if you're just only concentrating on risk, well, then what happens when you have profits? Are you cutting your profits too quickly? Alternatively, if you're looking at just looking at your profits and you're not sort of watching out for the risk, well, then you can end up with large losses. So, it's a big balancing effort when you're thinking about trading. So one thing I'd like you to think about, if all your assets are moving in the same direction at the same time, it's going to be a lot more difficult, very challenging to manage them efficiently. So here's the efficient market theory. EMT, the efficient market theory, states that rational investors should seek undervalued assets with low correlations that will help smooth out investment results. So let me give you an example. The natural resources, again, any sort of natural resources, but commodities, having negative correlation to bonds, because in the long run, usually when bonds move one way, that means people are preferring to earn very little rates of interest because they feel that you're in a very stable economy, although the economy is probably growing very slowly if you're willing to lend out money and not make all that much back. In fact, that's what we've seen recently. And that's, again, there are other kind of bonds. There are corporate bonds, which, again, have gone the other way. Corporate bonds, the yields have exploded. Why? Because people don't think that these entities can actually pay the money back. So, when I'm saying bonds, I'm saying, I guess what I'm trying to say is government bonds, but of course there could be corporates out there also. So there's an inverse relationship between inflation and the two asset classes. So normally, when you're looking at government bonds and commodities, you're going to see them move in the opposite direction. And that's what we've seen in the last year or so, especially recently, although the last couple of days we've seen U.S. government bonds actually sell off. Again, bonds are selling off and stocks are rallying. So there are correlations that will hold for a while, as stocks and bonds can move lockstep for a while, but then they may basically diverge. And again, last week, where the equity market actually had the first good week in a long, long time, the bond markets took it on the chin. Another example would be oil stocks and airline stocks. Why I think I've touched on this a couple of times already. Obviously, airlines use oil. So as the price of oil is moving up, well, if oil is moving up, then airline profitability is probably going down. Of course, that's a generalization. There are a lot of other factors that go into the profitability of an airline, but that is one of the major costs. Reversion to the mean. Theory suggesting that prices and returns eventually move back towards the mean or the average. This mean or average can be the historical average of the price or return or another relevant average. So what it's really saying is that if the stock market, at least this is according to the theory, if the stock market has a huge rally for a couple of years, many would say that the future returns are going to be a lot lower, because over the very, very, very long term, there's a historical rate of return that seems to occur in the markets around 8, 9, 10%, depending on the years that you select. So in practice, though, some companies, sectors, even currencies, although rare, may not ever revert back to their mean price due to some unforeseen event or events. And a couple examples: WorldCom, Enron, technology stocks. The Thai baht took a huge beating. Mexican pesos in the currency market are examples in the last 15 years. And just recently in Iceland, the Iceland krona just took an absolute beating, and it's probably not going to revert back to its previous mean of, let's say, a year or two ago. So correlation, groups of companies that have a much higher tendency to revert back to some previous price relative to individual companies. Larger currencies also may have a much higher tendency to revert back to some previous price relative to smaller currencies.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.